All right, ladies and gentlemen, let's get into it. We have US consumer spending and the PCE price index data. Don't forget to share this video with your fellow traders and friends and get that viewership going. So we've got quite a bit of sentiment to kind of go through and a bit of an understanding of what the release means and how it can affect the markets as well. So what is US consumer spending? So first of all, got to understand that US consumer spending just measures how much consumers are spending on goods and services. So the difference between CPI and the PC price index. First of all, PC includes prices in rural areas as well as those paid by organizations that are spent on behalf of households. So think of the PC price index as the CPI price index. Measures urban area inflation, so your towns, your cities, whereas the PC looks at, as said, rural areas, including towns and cities and the urban areas there. So that's why for the Federal Reserve, they look at it as the preferred measure of what inflation is doing overall, because it shows you a better picture of inflation nationwide rather than just focusing on the areas in the cities and towns. But then if you look in the CPI report, they will take that, people and economists and traders see it as more important than the PCE because it shows what's going on now, where money is being spent the most within the US. So how does the consumer spending report and the PC price index data affect the market? So first of all, with the currency, a healthy increase in personal incomes and spending bodes well for the US dollar, and high consumer demand encourages more growth and puts upward pressure on interest rates. So if we think about what the cycle that the Fed is still in at the moment now, they're still in their hiking mode, and inflation isn't anywhere near their 2% goal or 2% target that they have. So they still have a lot of work that they need to complete, i.e. that is to raise interest rates enough to kind of get to a point where they can hold the rate and then let the economy slow down by itself. Let the economy slow down through the effects of what has taken place through the Fed hiking cycle. There's also the tightening as well of quantitative tightening too, and that's rolling off or letting the bonds that the central bank had bought, letting that roll off too. So within this current period, within any period, to be fair, what would happen is that the currency would see an appreciation because of the fact that it means that the Federal Reserve could hike or continue to hike by a bigger amount in the future or hike for longer. That's the current debate. Is the Federal Reserve going to hike for longer than expected, maybe past May 2023? Or are they going to cut that timeline by maybe a month or so? Okay. Are they going to pause much sooner than previously anticipated compared to the summary of economic projections? So that's why that's one thing to bear in mind for the currency. Now, if we're looking at other areas too for the stock market, higher personal income and spending are viewed favorably in the stock market because that fuels economic activity and increases corporate profits. But in this environment, we know from the past reactions that we've seen, and we'll go through the deviations of the economic release for consumer spending and personal consumption expenditure index, that higher than expected data for consumer spending and PCE leads to the expectation of the Federal Reserve taking a stronger decision at an upcoming meeting or hiking for longer, and that doesn't bode well for stocks. So what actually happens is that the stock market it takes a hit instead, and you see depreciation in the S&P, the Nasdaq, the Dow, the Russell. All the stock indexes take a hit. Okay, that's what happens when we do get better than expected PC print and consumer spending print as well. Then for the bond market, any data that affirms sluggishness in the economy is expected to support higher bond prices and lower yields. Same thing in the tightening cycle too. when data is strong or the economy is on a strong footing, or maybe inflation is continuing to rise, usually what happens is that traders pricing that the Federal Reserve is going to raise rates to try and bring that down. So what traders do is they start buying these bonds, and the yield goes. And what happens is that they will sell. What happens is the bond yield, will go higher in anticipation of the Federal Reserve raising their rate by more or for longer, and in turn the price of the bond will go down. Okay, so for bond futures, when we're going to be looking at the 2-year bond price today, or 2-year or ZT today for our bond market reaction. When you start to see a strong economy, a stronger than expected PCE price index data, usually what happens is that bond prices will go down and the yields will go higher, again in expectation of a stronger rate decision or the Fed continuing the hiking cycle for longer than expected. Hopefully that makes sense for everyone so far. If that doesn't make sense, do let me know. Don't forget, share this video with your fellow traders and friends if you found this, if you're finding this live stream useful, and don't forget to like and share the video as well, and also subscribe to our channel too. So this is what I wanted to look at, is the previous report, okay, and for October. So the $147.9 billion increase in current dollars PCE in October reflected an increase of $85.9 billion in spending for goods and an increase of $61.9 billion in spending for services. So this is quite important to see what is spending appetite, what is the spending appetite like within the US. Okay, you see that in June that you had a big amount of spending going on for both in consumer spending for goods and services, but then it edged down as you had the hikes, or the interest rate hikes slowly starting to take an effect. And actually you'd seen a 1 month of bad data coming through for the consumer spending, especially the goods, where people were leaning towards the services side. But then you see this recovery here, and more or less over time, the key thing to understand is that for an economy to show that it's really getting back into the swing of things, is you want to see consumers jumping into not only services not only goods within the economy, but services. The buying into services that are more like luxury services, going to hotels, going to resorts, spending money on things that are not necessities. And that also goes for goods as well, luxury goods. Are people buying Teslas, or is there an increase in people, going for an iPhone instead, or in favor of going to a smaller or cheaper brand, right? That's sort of spending pattern, that you'd want to see, that if people are seeing an increase in their own wealth, in their own personal income, that you want to see that translated to a higher amount of spending overall in goods and services for the luxury area or the non-necessities. Okay, so at the moment, not too strong but not too weak in what we've seen in the last report in October. Visual Moore said, can you tell me about the data? Shindy Black said, chat, let's make a decision. Is this bullish or bearish? Somebody said Isaac. Leanne said bearish. But yeah, so that was the previous report there. So we'd also seen the price for goods increase 7.2% and price for services increased 5.4%. So we're focusing on the PCE price index data now. Food prices increased 11.6% and energy prices increased 18.4%. So all in all, you're seeing a bit of a recovery or a bit of resilience in the face of these hikes. 50 basis point hike is still a big amount, right? But we've been so used to the string of 75 basis point hikes that we had, or 4 of them to be exact, that 50 doesn't seem that big, but it is. But even with those rate hikes and getting to the 4.5% rate that we are at now, you don't see any shift in consumer spending or big shift or big downturn in consumer spending compared to maybe some of the other reports here. And actually, you're seeing a bit of an increase in consumer spending overall. So this is the summary of economic projections. PCE, right? Where do they expect inflation to be? This is something that, of course, the SEP, or the summary of economic projections, we had received with the last rate decision that had just gone. This had caused a bit of a stir within markets, and you'd seen a strengthening in the DXY and weakening in the stock indexes. The reason being is because of the upgrade to the Federal Reserve's expectations for where they expect their preferred measure of inflation to be, and second of all, okay, is where they see the federal funds rate in the future. So the key point being here is that one, you had PC inflation being upgraded for this year to 5.6%, and also in 2023, which is still well above the Federal Reserve's target of 2%. Okay, and even in 2025, when the Fed would have thought that they would have probably reached their 2% goal, they don't. they kind of do, but they're not there yet. So it's like a close but no cigar scenario that they have. So that had scared the markets into thinking, okay, the Fed is going to hike for longer. And as it's shown here, the federal funds rate expectation for 2023, expecting the rate to get to 5.1%, okay, with the federal funds rate or around that. And then in 2024 and 2025, there was an upgrade to where the rate is expected to be. So that's going to be very key as to what happens with the PC price index data today. Okay, that's going to be a focus for a lot of traders. Will that rock the boat enough if we do get a much higher than expected reading for the Fed to say, well, maybe we should hold off on a 50 and go back to a 75? Or does it come in lower than expected and cements the Fed's new path of going, or downtrend of going with a 50 basis point hike or not? So that is a question that traders, or those are the two questions that, or the scenario that traders currently have within their mind. And we've seen that evidently within how the markets have been trying to price in and then move out of their positions within what to try and expect for the next FOMC meeting that we get in February, by the way, or at the beginning of February with the FOMC. So that's going to be important today. The PC price index data is going to be very key to see what happens alongside with the consumer spending data. Now, what did Powell boys say? So Powell, in the last FOMC press conference, he specifically cited the higher the jump-off point for inflation this year as one of the reasons for the surprising upgrade to where Fed officials see prices at the end of 2023. And that outlook in turn led to a hefty upward revision to their projected path for interest rates. So again, an underestimation of how strong inflation is expected to be, which led to Fed officials changing, well, not completely, changing the tune to maybe hiking for longer, but not by a bigger amount at each meeting. Then some of the other views then as well. So Bank of America's Moynihan said that spending growth is beginning to slow. 16th of December, Alan Detmeister, an economist at UBS, said to reach their 2022 forecast, implicitly they would want a really strong December numbers for inflation baked in. So what does that mean? So if we go back, so if we're looking at the 2022 figures for where they expect inflation, if they're expecting, first of all, this is PC price index, right? Then you have the CPU price index. So if they're expected to be at 5.6%, if they're expecting a higher, inflation to kind of stay higher for longer than they anticipated, then that kind of, that could throw off throw off the Federal Reserve in their decision making. And what they say is that on the basis of the CPI data and you also have another Labor Department report on producer pricing, economists at JP Morgan also see core PC price index increased by 0.1% or so in November. The 19th of December, traders who have begun to wager on big reduction in inflation are setting themselves up for disappointment, according to analysts at BlackRock. I don't think that's surprising. I think markets are looking for some positive sentiment from the Federal Reserve to try and say, okay, if you're going to decrease the strength of your hiking pace, then why don't you, give us a sign that of, a stronger sign of when you want to pause. And in turn, the markets will try and price that in. And you probably see, and as we've seen a lift in the stock indexes, or we've seen a movement towards the downside in the dollar as well from the last CPI report that we had. But that's the expectation from the markets that maybe from BlackRock, should I say, that maybe the markets are probably jumping the gun a bit too soon for expecting the Federal Reserve to believe that inflation is actually going down by as much as they would want it to. 21st of December, you had Jim Caron of Morgan Stanley say the markets aren't ready for how far the central bank or central bankers will go to control the highest inflation in a generation. He added that I don't think hiking cycles are sufficiently factored in. What's priced in is that people anticipate a decline in interest rates. And I think we need to heed to what the central banks are saying, or central bankers are saying, and their concerns about inflation. So again, these investment banks are looking at the bigger picture, or focusing on not just the now, but the expectation for the future of where the Federal Reserve is likely to be headed and how fast are they going to get to that destination that they would like to get to. It's similar to BlackRock. Again, markets are looking for optimism from PCE data and also the CPI data, seeing a move towards the downside, or a little bit of a depreciation in the inflation figures, and taking that as a sign that the Fed is going to be preemptive in their actions in the future. But something again that the Fed or the investment banks, BlackRock and Morgan Stanley, are saying, hold on, son, we're not done yet. So what does that lead us to then? So where is the economy, right? So now we have an understanding of what the release does, an understanding of what Powell has said beforehand, what investment banks think. Now we've got to understand, where is the economy at the moment? What is the Federal Reserve looking at? How is the data that we've seen in other areas of the economy, how is that going to affect the PC price index report and the consumer spending report that we get today? Could we see a reduction, or could we see a bit of upward momentum? So inflation, of course, went to 7.1% compared to the prior of 7.7%. That's the CPI figure. Non-farm payrolls was at 263k versus the prior of 261k. Retail sales went into the negative at minus 0.6% compared to the prior of 1.3%. Core retail sales also in the negative too, at minus 0.2% compared to the prior of 1.3%. Consumer spending at 27 billion versus 25 billion, so a little bit of an increase there in the amount of credit that's being taken. The unemployment rate remained unchanged at 3.7%. Q3 final GDP, of course, we've had that today. It was at not today, it was yesterday. It was at 3.2% compared to the second quarter final data at minus 0.6%. Now, yesterday, just to make you aware, if you didn't trade GDP data, and actually what happened was that you'd seen the Dixie move towards the upside, moving towards the downside in the S&P 500. The reason being is that the economy was more productive than expected in the final read. Usually with final reads of GDP, you don't get too much of a deviation occurring. The forecast was 2.9% as compared unchanged from the prior. It came in at 3.2%. So that little jolt to say, okay, even the final data an economist had got it wrong, that actually the economy performed better than expected, led to that market reaction that we had seen yesterday. The UMich, or the University of Michigan 1-year inflation expectation, downgraded to 4.6% compared to the prior 4.9%. The 5-year inflation expectation remained unchanged. So what are consumers feeling? That's what's important too. Are they expecting inflation to fall down? That could translate into consumers maybe spending less in the future if they feel that inflation, if they feel that the price of goods that they're paying for is still too high, and that might put off, or maybe they've borrowed a lot of money from the Fed, or excuse me, not from the Fed. Lucky them. They've borrowed a lot of money from the commercial banks, but they don't have, they might have realized that they've got a high rate of interest to pay back on that credit that they've taken out. So it could mean that they may be feeling a little bit more wary about their own spending in the future as well. Now, the triggers for the economic release. This is important, okay? So consumer spending. So this is what forecasters and investment banks see as their high and low estimates of the range that they have today, okay? So if I just bring up this here. So consumer spending, they see a high estimate of 4%, and the forecast today is 2% for the median estimate, and then on the low end they see minus 0.1%. Personal income, they see a high estimate of 7%, with a low estimate of minus 0.1% as well. The PC price index, they see 0.3% with a high estimate, and then 0% on the low. PC price index year on year, again, it's going to be very important for what inflation is doing in the whole of America rather than just the urban areas. Seen at 5.7% versus 5.4%. Core PC prices month on month with a high estimate of 0.3% and the low of 0.1%. And core PC price index year on year with a high estimate of 4.8 and a low of 4.6. Now, just some other bits as well. We'll go through the deviations. Let me just bring that up over here. And we'll see, and what I'll show you is, so if you're unfamiliar with what deviations are, you're saying, Tony, dude, what are you on about? What are you smoking? This is what deviations are. The deviations shows you what I've compiled together, how the markets have reacted to each economic release. Okay, so you can see I've got a load of data for how the markets have reacted in the past. So usually so this is what I want to show here. So when you have more of a mixed picture or mixed bag, well, actually, let me start off when you get a clear one direction. Okay, when you get one clear direction of the data going in one way, you tend to get a stronger reaction from the markets. So whether it be, as we can see here back in the 30th of September. So what this represents is the initial move going to the wick of the candle, okay? And the brackets here shows you the market reaction 10 minutes post 10 minutes after the release. And that doesn't go to the wick of the candle, that just goes to the end of the candle. And the most important point being is what happens on the first candle. How big is the reaction? So that's how I like to do it. If that confused you, if you were looking at the deviations beforehand. So when you've seen data going in one direction, you've seen a decent move from the markets, more so from the stock market rather than the currency pairs. Okay, we know with the CPI price index, we've seen huge moves occur within the dollar yen, cable, and the euro dollar. Okay, just to name some of those currency pairs, as alongside with the stock index is also seeing a big market reaction. We don't get too much of a market reaction, or as big as a market reaction as we do with the CPI with the PCE price index. But there still is a decent move that occurs, but it depends on how the data plays out. So again, as I said, if we do get one data going in one direction, either up or down, you can see that back on September 30th, you'd seen on the NASDAQ, there was 514 tick move towards the downside, 134 tick move towards the downside on the S&P. I'm losing my voice. Okay, there we go. Clear my throat. You guys don't want to hear me clear my throat. It's not nice. But on the dollar yen, you can see this was back when actually, let me just kind of, as to why you didn't see, you might have seen a bit of whipsawing. This is when the Bank of Japan was intervening within the currency market. Ali Akbar Dreamer said, marijuana? No, sir. So this is when the Bank of Japan was intervening within the currency market, trying to stabilize the currency. You saw a bit of a mixed whipsaw reaction there. Cable was the biggest, had seen the biggest reaction out of all the currency pairs compared to in that report there when data came in line, when data was much higher than expected. Now it's more of a tussle between, more so between the dollar yen and the pound. So you can see here the next report where the data was mixed, the dollar yen took over, and then you had cable in the next report, the last report that we had, take over again instead. So dollar yen and the cable are going to be interesting to watch. If we're looking at some of the other currencies, nah. Yeah, you might get, you could see some movement with a dollar CAD. That was more of a seemed more like, only a couple of times where you'd seen the dollar CAD have a stronger reaction compared to the euro dollar. So, but that's what we've seen historically. Okay. Dollar yen and cable historically have seen slightly stronger moves compared to the other currencies. Then, but as I said, you get more of a reaction. You do see some, depending on which way the data goes. If it's mixed, if it's one clear direction, you more or less could get more of a reaction from the stock indexes instead, or as a bigger or a nicer, cleaner reaction from the stock indexes compared to the currency pairs. Now, if we're looking at gold as well, so gold last time round, data was mixed. Really didn't see that much of a movement occurring. Even the bonds, bonds, you can see here, it ended up flat. So it was 10 ticks up on the 2-year bond. And after about 10 minutes of trading, it ended up flat, as did the 30-year bond price. But again, that's because the data was more mixed. There was no clear direction. Yes, we have 3 minutes. Wow, time does go past pretty quickly. So that was that there. Let me show you the video. We're going to have to kind of go skip this. Let's go here. Well, what did I do there? Well, I just showed you the last release. Oh, no. That was my voice. I thought the background looked very, very similar. Apologies for that. Okay. Oh. Okay, so there we go. So that was about 3 seconds before the release. So this is a prior release that we had. Okay, it's seen. So you would also have initial jobs claims data coming through too. If I kind of just skip ahead a little bit. Okay, so will the data come out? This is the S&P 500. This is the dollar yen and your bond price. Okay, we've got 1 minute left to the release. So you can see with a mix of data that there was movement towards the upside with the data, even though more or less traders took it as inflation is cooling, but it's not that strong. So that's how we got to kind of take the market reaction is if inflation is smaller than expected overall, you'd expect a positive reaction from the stock market and a negative reaction from the dollar. Let me get TICKSTRIKE up and running. Yes, we have less than a minute now. Got 17 seconds. Dun, dun, dun. All right, go give the US releases. Okay, 10 seconds. Less than 10 seconds. Market's already trying to move here. Let's see what we got. Come on. See what you got. Oof. Okay, spot 1% for consumer spending month on month. Okay, markets are still quite choppy here. Waiting on the other bits of data to come through. Whereas the... Yeah, still waiting on the other bits of data. This is what's happening. Let's see. Okay, there we go. 5.5%, 5.5% for the PC price index year on year. What else we have? We have, we have PC price index month on month at spot 1% as expected. Core PC prices spot 2% as expected. Core PC price index year on year 4.7%, 4.7%, higher than the forecast of 4.6%. Other than that, Jeepers creepers. That is a mixed bag of data. There's nothing. Durable goods is also down by point. It was worse than expected, at minus 2.1%. Yeah, personal incomes were up spot 4%. This is more of a whipsaw reaction. Yeah. Merry Christmas to you too, Bricktop. Look what the markets did. I mean, there's hardly any trading. There might be hardly any trading that's actually going on, but even then, it doesn't look like a pretty sight at all. So yeah, whipsawing off of the back of that release that we had. But let's just, I guess we've got to measure what the markets were doing. So let's see, what do we get? So I'm going, as I going to the, whoops, no, we've got to start here. Let's see, what did you do? You acted very weird. This, so not that much of move. Okay, now we're seeing maybe getting a bit more of a clear direction with the market move. So a mixed bag, really. So kind of what we'd seen. Let me just bring up the deviations again for you. Kind of like what we'd seen last time round, to be honest. Where are we? Spending. Come on, come back up. Yeah, there wasn't really... Okay, so smaller move compared to what we'd seen last time. If we're looking at the... What? Actually, no, I'd say that again, but just off that little that candle there. A bigger move than last time on the S&P. So look at the NQs, get a clearer... See if we can get a cleaner move or market reaction. Hey, would you look at that? Oh goodness. Oh golly. No. Let's see. 283. Okay, that was bigger than last time. Right. So markets are still down. So the only way we can kind of take it is that the core data was higher than expected. And that, and considering, and the rest of the report being quite mixed, doesn't really help. That maybe means that inflation is still sticky and not moving down fast enough compared to what economists were, economists were expecting, and maybe they would expect more of a clean break, but we didn't get a clean break or clean figures. See what the dollar did. Kind of, yeah, dipped down a little bit, but to be honest, I'm going to probably ignore that and just go see where we are now, or the peak where we were. We got to 29.3 pips. So you can just ignore that. It doesn't say 293 pips. There we go. 29.3 pips towards the upside there. Okay, so post release, just so far for now. That's what we have. But that was the initial reaction. We kind of waited a little bit for the data to come through. So yeah, a whipsaw initial reaction, but inflation is still sticky, not moving down fast enough. Enough for the not moving up fast enough for the stock market to say, yeah, this is good. Merry Christmas, you filthy animal. It's not enough. Right. Right. So that's the. Let's look at the bond prices, and we'll also take a look at gold too, and some of the other currencies. Let's see what we got. You know what? That should. Whoops. No. Should start there. Okay. So about. Again, yeah, not too much move there from bond prices. Go. That's 17 ticks down. Let's go for gold. Let's see. Got gold. All right, small move. I think that was slightly bigger than than the last report. So yeah, gold had a slightly bigger move, marginally bigger move compared to the last report. So 36 ticks down. Last time around we had 33 ticks down. The only thing will be to see if does it stay down. Okay. But if it's a mixed report, meh. Don't know. We'll have to just wait and see. So that is that, ladies and gents. Next week, guess what? Or this Sunday, guess what? It's Christmas time. Ho ho ho! Well, thank you very much for joining me for the last edition of MACROACE for the year. It's gonna be time to get that pot belly going, get those mince pies in my belly, get that turkey, get that chicken, get that gravy going. Gravy train. It's eat so much, it's bust a belly. Probably gain, a couple of maybe 10 pounds of weight. Probably become a turkey by the time it comes down to the new year. short arms and a big old belly. But hey, thank you very much for joining me. Hopefully you guys found that useful. Now, one final thing before you go, before you guys leave.
Don't go. No, not yet. Please, wait. I'm not done.
We have FinancialJuice, where we got the data from live. Okay, FinancialJuice. We are doing a 7-day free trial of FinancialJuice, FinancialJuice Pro. So if you're a user of the light version, you will know that there are adverts being played. There is a delay to the website. And that's not really useful, right? You want live information as soon as you can to be able to capitalize on potential trades, manage your risk, understand what's going on within the economy or geopolitically. What is Putin saying? Where is Putin putting his missiles in? Which country is he staying in Ukraine, or is he going to go to, I don't know, Moldova or maybe even Poland? Heck, the guy's crazy. He can do whatever he wants. But no, I mean, he's just nuts. So that sort of news, right? Remember, investment banks always have access to a voice and text service because that's the high level stuff. For retail traders, they don't really have access to a voice and text service. It could be something that's completely new to them, or but you want to know why the markets are moving in a certain way or direction. Come to FinancialJuice. Have a little trial. Have a little play. 7-day free trial of FinancialJuice. First of all, what you need to do in order to get the 7-day free trial and make sure your site works is to have, first of all, make sure you have an account on FinancialJuice with your own username and password. Okay, get that up and running. Verify your account. Okay, you'll come up with an email. And then to verify your account, go back to the website, and here you'll see a button that says Go Pro, right? Click on that. Then if you want to, you can pay for the service too. And then if you do decide to pay for the service and do decide to go pro, make sure the next step is once you've paid for it and you've got your own account, is you go back to the website, log out, log back in, and then you'll be able to access the pro version of FinancialJuice. Make sure you, regardless of whether you're pro or not, don't have any VPNs running on the website or any big old ad blockers removing or stopping everything. That will mean that the site won't work the way it should be working. Okay, you don't want that to happen. So the voice stream, here we go. So you have the live voice stream here, the live feed of the text as well, and the economic releases. Also the economic release on the left hand side. You don't want that to have any issues, so make sure you get that sorted first before you say, hey, why is it not working anymore? I can't hear you guys. You don't want to do that. So that's FinancialJuice. I've put in the link there to go to the FinancialJuice homepage. And finally, TICKSTRIKE. So TICKSTRIKE, if you've been looking at it thinking, what are those weird colors and numbers and symbols? What is all that about? If who here has used TICKSTRIKE before, right? If you've used TICKSTRIKE, just pop a chat or pop a thumbs up and we'll say there, yeah, oh yeah, I've used TICKSTRIKE before. If you haven't, so what is TICKSTRIKE? It measures you can listen into the order flow of the markets, okay? Or another way to put it is you can measure how strong is the buying or selling momentum within the certain asset class. So here, so you can trade not only in Forex, we use TICKSTRIKE for Forex, you can use it for stocks, crypto, futures, and internals. When I talk about internals, we're talking about the VIX and those sort of things as well, the ADD too. So what are all these colors then? What's this number, right? So the color doesn't matter. You can kind of set it to whatever you want. But the key important bit is so the minus figure shows you the selling momentum and the plus buy momentum. So on here, you have a little dial, right? Kind of a little slider. So going from 1 to 15. 1 is the most sensitive to market reactions. So if there's a bit of buying or selling momentum that's going on, as you can see, there's some selling momentum here on the dollar yen, then TICKSTRIKE will go off with a little sound and visually as well. But if you want to see the markets move when there's a big amount of buying or selling momentum that's going on, then you can push it all the way up to level 15, which is the least sensitive to market reactions. Again, if you're a day trader, this is a perfect tool for you to use. You can manage. Some of our users have said that you can they've used it to manage the trade, capitalize on potential trades, scalp trading as well. That's another way that a lot of users use it. But of course, find the way that kind of works for you, right? What method works for you to trade with or use TICKSTRIKE. So there's a 7-day free trial of TICKSTRIKE as well there. Now don't forget, on the website you have a limited version of TICKSTRIKE on the S&P, Eurodollar, oil, and Bitcoin, but that's set at a certain level. You can't chop and change the level to what you want it to be. So that of course, it's free. It's there, kind of play with, and when you're ready to go pro, I guess, or upgrade to the full version, then the link is there for you to go ahead and do that. So don't forget to subscribe to the channel, give it a like, give me your love, share the video and the channel with your fellow traders and friends. Enjoy your Christmas. Have a wonderful new year, and I will see you guys soon. Sayonara. Oh, and then finally, MACROACE. Yeah. So if you want to, if you want to get the deviations, if that was your next question, deviations, completely free. There's no need to pay for anything. Just all you got to do is just sign up to the MACROACE mailing list, and you get that too, which is there in the link. Sign up to that. You also get a little prep of what to expect for the week ahead. It's not too big. It's quite short. What to expect in the US, Asia session, European session, and a summary of the weekend news. Alongside with the deviations, the link for the live streams too. Again, it's not big or crazy or fancy. Just a short bit of text to kind of explain what to expect for the weekend. All right, you guys, take care. Goodbye, and I will speak soon. Ciao.